If you want the PowerPoint presentation, my email's on there, my phone's on there, but send me my email. Don't charge for phone calls, so if any questions come up, but send me an email and I'll send you the PowerPoint presentation. That's me. Actually, I head up our dealership industry group. I work exclusively with dealers, have worked exclusively with dealers since 1987, so that's a day or two. We've got 41 people on our dealership team and handle dealerships pretty much all over the country, but and work closely with the various associations between EDA and regional associations and so forth. So I'm probably the strangest CPA that most of you are going to meet. I'm probably the only CPA you're going to meet that's actually run a service department. GM to store, I actually owned a dealership as well. So a little different perspective on operations than most of the bean counters, if you will. So, but today we're going to be talking about taxes. And I am going to, we're going to focus on dealership specific topics. I've got at the end of the presentation, I've got several slides that we probably won't get to, dealing with the framework trumps tax proposal, if you will. Since that's a very, very hot topic at this point. So we probably won't in 30 minutes be able to get to that, but you'll have some slides if you request the presentation. So first item is the net investment income tax. This is a tax that is hitting a lot of dealers and it's hitting them unsuspectingly. Where it hits the dealers are for those of you that are doing any rental. So if you've got a rental fleet, much of a rental fleet at all, that is passive income, that's investment income according to the definition, and that is subject to the net investment income tax. The net investment income tax came about because of Obamacare. It's to pay for Obamacare, all right? So there's an extra 3.8% there. Go back, check with your CPA, ask them if they've subjected your rental operations to the net investment income tax. They should be, unless you meet some of the exceptions. Now, there's exceptions, again, specifically to the dealerships that will get us out of this. There's some case law, and there's some technical advice memorandums. So as we work through it, what I would encourage you is, if you're in that situation with net investment income tax being assessed, or if your CPA hasn't assessed it but doesn't know enough about it, wants to talk about it, have them give me a call. I don't charge for phone calls. That's the second time I've said that, so give me a call. I don't charge for phone calls, and I'll help them out. I'll help them walk through the problems and the issues. But this is jumping up and biting a lot of dealers. One thing that dealers are forgetting sometimes is the personal use of company vehicles. And I'm actually amazed that this is still an issue with CPAs, where they are not adding that to your personal tax return, the personal use portion of your vehicle. You have a 100% chance that if you get audited, that is a 100% chance that the agent is going to ask you about this. Okay? Have you added any amount for the personal use of the company truck? Running to the grocery store, going to the kids' ball games, those types of things. Okay? So you need to have something that's added to your W-2. You've got probably about a 60% chance, if you say, yes, we've added something, 60% chance that I'll ask to see the calculation. You've got about a 30 or 40% chance that they won't. Those are non-scientific, that's just been my experience. So what do you need to have? You've got to have an agreement, a written agreement. This goes for your employees who are driving trucks as well. I've got an article that I'm happy to send, and a memo there's a memo that needs to go to your employees on how you're calculating it. So since it's a high-profile issue with the IRS, we suggest to you that you put something on your W-2 for that. And then UNICAP, it's an acronym. It doesn't really matter what it stands for. It's Uniform Capitalization Rules. Dealers, the IRS was aggressively going after this. Basically, they were taking dealers and they were adding what amounted to some overhead costs that we would think would be normally deductible. Think about the wages we pay our parts people. Okay, our rent, our utilities. And they were saying, no, a portion of that needs to be attached to each one of those parts that you're selling as an overhead allocation, and so it's not deductible. Well, that became a big issue, all right? So we approved, or we got, in the mid to late 90s, we were filing what we called zero unicap, okay? Where the calculation came out to zero. You were still subject to the rules, but the calculation came down to zero. Finally, in 2010, the IRS agreed with us that there are some exceptions for dealers. For most of my dealers, we are exempt. We are still subject to unicap. The calculation comes out to zero. We just need to make an election. If you don't make the election under 2010-44, which is a revenue notice, then the IRS can put whatever methodology they want in place. Okay? There's a dealer in Chicago, not an OPE dealer, just to be honest. There's a large dealer in the Chicago area that had a $1.8 million assessment related to this. They had zero. They didn't make the election. The IRS came in and said, well, this is how we think you should calculate it. We don't care that 2010-44 exists. You have to make that election. So the takeaway on your part at this point is, go back to your CPA, ask them if they've subjected you to unicap, and if they say yes, ask them if they've looked at the exceptions for dealers in 2010-44. Again, call me, I can walk them through it. We know this basically like the back of our hand. If you have off-site storage of either whole goods or off-site storage of parts, you will not be completely exempt from this, okay? But other than that, the dealers that I work with, we work through the case law and these exceptions to come down to zero. It's a significant number, and you are at risk forever unless you make this election. Okay. Dual use property. This kind of gets back to the rental again. If you're renting, the IRS has proposed regulations, proposed in 2013, that says for your rental equipment, is it inventory or is it a fixed asset? Is it inventory where you don't deduct any costs associated with it, you don't get any deduction until you sell it, or is it a fixed asset where you get to depreciate it as it's being used? Well, we think that this is fairly well settled. We don't believe that the proposed regs will ever be finalized, and we hope that that's the case because it's detrimental. What the IRS is wanting to do if you're renting equipment is they're wanting you to take all the rental income in and tax it in the year you receive it, but not take any deductions related to it, none whatsoever, until you ultimately sell that equipment 3, 4, 5 years down the road. Obviously, that's not the match. That's not the way I want to time my deductions. So, that's just I guess something to be aware of that could come up and could be out there. LIFO. LIFO is not as complicated as what you're led to believe. It's a mathematical calculation. It's all on us. We do the calculation. What I want to let you know is most of our dealers, again, we've got hundreds of dealer clients, most of our dealers are on LIFO. What it amounts to, the benefit for the dealers is it's a non-tax deduction, or it's a non-cash tax deduction. In essence, I've got an investment in my inventory sitting on the ground anyway. Why don't I take a tax deduction for that? And we can. For it, basically what it amounts to is the
So
inflation.
if there's a law,
Basically the inflation on that. Do we know what's causing that? No idea. Okay. So I'll try to
time goes.
ignore it if I can. Any rate, it's a benefit to the dealers. You are not spending any money to take this tax deduction. It is a result of just having inventory, and it's the inflation on your inventory. So it's about 3% or so, roughly, of whatever your inventory costs are. Sorry again about that coming through. Let's see. Repair versus capitalized regs. I'm sorry. Those regs came out a few years ago. There are some specific benefits to the dealers. Basically, a lot of what you have capitalized in the past, or your CPA has capitalized, things like repairs to your roof that they set up and expensed over a lifetime of the roof. we can now take an immediate deduction for that. So that's great. A lot of other things, retention ponds, retaining walls, just a lot of things that you do around the facility that are big dollars. Okay, we can take an immediate deduction for it. Furthermore, if you capitalize those costs a few years ago, we can take whatever, let's say you capitalized a $50,000 roof 3 years ago, and you've written off, whatever, $5 grand of it over that 3 years. We can take the remaining $45,000, take a deduction this year, today, for that. Now let's think about the impact and why that's so important for 2017 as a tax deduction. Trump's proposing tremendous changes, including reduction in rates, probably to go into effect in 18. So if I get a tax deduction today at a higher rate, it's going to save me more money than if I take the deduction in 18, 19, or 20 at a lower rate. So let's do these now, okay? All right, that's the repair versus capitalized recs. Used equipment write-downs. It's funny, I get some, believe it or not, I've gotten some CPAs that have told their clients that you cannot do write-downs for used equipment. Okay, we know that you can. I actually assisted the IRS in writing some regulations relative to this, so I can tell you, gospel, if you will, that you can do this. Again, if you have the issue, have your CPA call me or call me together with him. It's a lower of cost or market adjustment is what it is. Okay, so it's the market. It's the wholesale market, it's not the retail market. And we get that problem with some CPAs as well, where, hey, you sold it in the spring and made money on it, you shouldn't have had a write-down. There's no write-down in December that you're year in.
And if
no, that's not true. We can take a write-down to what would you buy that piece at an auction or from a jockey or whatever. So it's a lower price, a lower level. Those are deductions. Again, hit that hard at the end of this year because of the tax rate changes. Even if you sell the product in the spring of 18 and recoup the write-down, I took a tax deduction at a higher rate this year and I'll pick it up as taxable income next year at a lower rate. Okay, make sense? Yep. All right. Parts obsolescence. For parts obsolescence, you are prohibited from taking any write-down for obsolete parts unless you get rid of them. You have to scrap those parts. You have to get rid of them. There is an argument. I just talked about lower of cost or market write-downs for used. There's an argument. We've made the argument before with regards to parts that there's a lower cost or market adjustment there as well. We've successfully made that adjustment. But technically the rules are you have to actually scrap that in order to throw it away, get rid of it. Most of our dealers, if they've got space, even if they don't have space, tend to hold on to this stuff, and a lot of the parts have an inch worth of dust on them and those kind of things. But that's actually part of yesterday's discussions or presentation. I'm not going to talk about like-kind exchange treatment. I guess I will, just real quickly. Like-kind exchange treatment on your loaner fleet or your rental fleet. That's a good tax savings methodology. It's just like like-kind exchange on real estate, where, hey, I don't pay tax on any gain as long as I take the proceeds and buy replacement real estate. Same thing on your rental fleet. You don't have to pay that tax, okay? So just kind of keep that in mind. And then for any of you that are placing the loans and receiving commissions, your finance or selling any product, maintenance contracts, those types of maintenance contracts aren't cancelable. Extended warranties and those types of things. I mentioned those chargebacks. If somebody cancels, they get a refund, and you don't find out about that until the month after they cancel. All we do, it's not big numbers, but we just accrue those back into December, even though you find out about them in January, so we take them as a deduction in the proper year. Again, cutoff for this year is going to be very important to us because of the tax rate changes.
Sales and manufacturing.
Okay, the next topic is a cost segregation study. I met yesterday with an OPE dealer right in this room who is spending about $1 million for a brand new facility. And there are some tax advantages if you're
United States every day.
acquiring, so
And
buying a new
EPA
facility,
estimates that
buying a new
50%
location.
of this is-
If you're building a new location, if you're expanding your location, or if you're re-imaging, if you're putting a new facade or dressing it up, if you will. There's some big tax advantages. The slides walk through this pretty well. What I want to get to is the fact that without doing this cost segregation study, the IRS will say that the life of those improvements or that building, that $1 million investment, is 39 years. Okay? I'm 55 years old. I'm not going to be here in 39 years to take that deduction. Okay? The dealers often are wanting the deduction today. I want the deduction today. What a cost segregation study does is it accelerates those deductions into today. So over the first, just the red line, I don't know if I've got a pointer or not here. Yeah. Okay. So without a cost segregation study, we've got a $10,000 a year deduction. With a cost segregation study, I'm taking a $40,000 a year deduction. So there's some benefits to this. Okay. Again, I'm not going to go through all these slides. We just don't have some time. Now, since I'm talking about facilities, some of the manufacturers, yes, I'm telling you the truth, okay, some of the manufacturers are giving some assistance payments. It doesn't happen very often, but if they want a new facility, some of them will participate. They'll give you money to help you with those costs, okay? There's some tax treatment for those assistance payments. There's a court case, it's the Freedom newspaper case. Actually, Freedom Newspapers is a Louisville case, actually, since we're in Louisville, that supports our position of saying that's not taxable income. So you get an assistance payment from the manufacturer. Most CPAs would say, hey, this is taxable income for you in the year you receive it. We would say, no, it's not taxable income, and it's supported by the Freedom newspaper case. And then I already talked about the facilities expenditures in a couple of different ways, the capitalized regs and the cost segregation study. So both of those are real important. Now, when you're doing reconditioning on your used inventory, if you take a used piece of equipment in on trade, your service department, your labor, your service department makes a profit on that, and your parts department has some markup on those parts that it puts into that equipment, right? Okay? So what we're doing is we're basically moving money from our right pocket to our left pocket. Why are you paying tax on that? You haven't sold anything to an end customer. So what we do is we go through your ending inventory and determine what we've got in gross profit. Our labor gross profit's about 70%. Our parts gross profit's about 30%. We've got a dollar for dollar, $1 a labor and $1 a part. I've got about 50% of the cost of the repairs that comes off. It's just the way the math works. Okay, 50% of the cost of the reconditioning comes off. I don't have to pay tax on that. Why pay tax on something that you've not sold to anybody at this point? There's still some, the WOTC is a work opportunity tax credit. Those credits are still out there. It's for hiring unemployed people and veterans and so forth. There's a good little bit of paperwork associated with that. So get your HR people, get your personnel department in tune with this so that they're in front of it. But these are credits against the tax. It's free money for you. You're hiring these people anyway. Think about your service shop. You hire a veteran who maybe has been a mechanic in the service. He comes to work for you under the right criteria. You get a credit against tax. That's found money. Okay, so just keep that in mind as well. Prepaids for tax purposes. You've got legitimate prepaid expenses on your books. For tax purposes, for the dealerships, almost universally those are deductible. So let's take the deduction instead of leaving it on my books as a prepaid item that I don't get to deduct until next year. Let's take the deduction today. Okay? So prepaid expenses, if I see prepaid expenses on a dealership tax return, I want to look a lot deeper at that. Okay? Maybe big numbers, maybe small numbers. Today, the ports, retros, and over remits, those are if you are selling product, you're maintenance contracts or extended service contracts and you have your own reinsurance company. I'm going to skip through that because it's very complicated for a discussion that I've got a limited time to go through. Then the last item on this slide is termination payments from the manufacturer. We are getting some, as I mentioned with the facility, sometimes we're getting payments if your manufacturer is wanting you to merge with somebody else. There's some assistance payments for you to kind of go away and merge in. We've got some specific tax treatment relative to that. Basically, bottom line for that is that's not ordinary income. We've got some specific rulings that tell us that that's capital gain income. And a CPA who's not familiar with this industry will likely not know about those rulings. So if that's in the future for any of you, or if you're one of the acquirers, it could be nice to know that, to share with the dealer that the dealership you're merging in, because it'll make a difference for them and it could make the thing make sense if their tax rate is cut in half, basically. Okay, electronic record keeping. This is actually a big deal. Revenue ruling 9825 came out in 1998. This is not new. Okay? Dealers have been subject to this for a long time. If you keep your books and records on an electronic format, okay? You're using C systems out here, DIS, whatever. Even going into QuickBooks. You are required to keep those records in a format that the IRS can take it and slice and dice it however they want. They want to do their own statistical sampling. It is not, oh, we're giving you a PDF copy of this. It is the data, raw data. What you need to do to take away from this is you need to contact your DMS provider, your software provider right now, ask them specifically, are you 9825 compliant? If they are not, you are in trouble, not the provider. It's your problem if the IRS comes in. I have an IRS agent. We have an audit going on in Toledo. Okay, the agent has raised this. They got the computer specialists involved from the IRS. This has become a huge deal. Okay, the reason it's become a huge deal is this is the third audit. We just recently picked them up. So we picked them up because of the audit, as a matter of fact, because of our specialization in the industry. This is their third audit. They were told, you're not 9825 compliant, you need to get that way. Second time, you're not 9825 compliant, we're going to slap you on the wrist. Now, you're not 9825 compliant, you are ignoring us, we're going to assess hundreds of thousands of dollars in fines and penalties. Okay? That's not small. Okay? I don't care who you are. All right? So it's a big deal. Tool plans. Check the clock. All right, I'm doing it. Tool plans. We see this every once in a while, and it's typically an insurance agent that'll read something, find something out, and he'll start going around to dealers saying, hey, I can save you a lot of money. You need to sign up for this program that we've sponsored. And what it amounts to is, when you hire a technician, this is the thought that they're going through. You hire a technician. You're hiring the technician, you're paying him for his time. But he's also bringing his tools to your shop. So why don't we pay him for the rental of his tools? And then we'll pay him for his time as well. So we're going to take, instead of paying the guy, I'll make up numbers, $15 an hour, we're going to pay him $10 an hour, and we're going to pay him $5 an hour for the rental of his tools. The reason that that's beneficial is because the $5 an hour for the rental is not subject to payroll taxes. So the employee pays less in taxes, and you do as well.
But
all right?
no rental business.
But, well, it goes beyond that. There are accountable plan rules, okay? And the plan, every one of the plans that I've reviewed, furthermore, the IRS took this up as an initiative to review these tool plans. Everyone that they've reviewed have not met the criteria. So my advice is run, don't walk the other direction. Actually contact your state or regional dealer association. Let them know the guy's there. Have that guy contact the association. Likely then I'll get the call and you won't hear from him again. He'll go away because he'll get scared because at this point it's a tax scam and he could be held responsible. So it's not a good thing, I guess, at the end of the day. Run, don't walk the other direction. SPIFs from the manufacturer. Some of the manufacturers will pay your salespeople directly, a spin or some sort of an incentive for selling a piece of equipment, right? Okay. Some of the dealers take those directly themselves, okay? Those are not subject to, first of all, you don't have to take those numbers, even though some of the manufacturers will report that to you, say, hey, I felt the manufacturers paid Billy Bob $750 in SPIFs this year. You do not have to report that on their W-2. That's the first thing. There's a misconception out there that you have to pick that up, somehow add it to your W-2, and pay the employer portion of the taxes on it, and it becomes a mess. That revenue ruling 70-333-37 says no, you don't have to do that. But furthermore, and this is the impactful piece, the employee does not owe Social Security taxes on that, or the Medicare tax on that, when he pays it on his files his individual tax return. So that's a 15+%, 15.3% saving for the employee. That includes the owner, if the owner's taking those spiffs as well. Okay. I think the next slide, yeah. I want to talk a little bit about audit activity. Yeah, I've only got 3 minutes. These are some items that get some attention. Cost segregation study, you told me, I talked about that a little bit ago. They're not a problem. They just want to look at it. And if we do it properly, which we do, it's a joint effort between an engineering firm, and we've got engineering firms that we work with that are dealership specific, so they know how they're built and where the advantages are. So it's not really a problem. Basis is a problem. If you're a flow-through entity, an S-Corp or an LLC taxed as a partnership, basis, you've got to track basis. Too many times we're picking up from an account from an existing CPA, and they haven't tracked that forever. And it's a big deal. If you get audited, they're going to know what your basis is, and you've got to provide that. Your basis basically is what have you invested in the store, less what you've taken out, plus what the store has made. It gives you a number that you can deduct losses against. Related party transactions. Officer and owner notes receivable. The loans always get looked at. There's a case out there, the right case, and in the right case they did it wrong. Basically, it's got to be a performing note. You've got to be paying interest. You've got to have maturing terms and those types of things there. And then we've got some dealers that consider themselves active, and maybe it's grandpa who still owns it but isn't really working in the business. He's probably passive. He's probably not working in the business. So there's some different tax impact, major tax impact between being active and a passive owner. Compensation. This is a big deal, especially those of you that are still C-Corps. If you are managing your taxable income down by declaring bonuses, okay, I would caution you against that without setting your pay plan at the beginning of the year. It can change from year to year, but set your pay plan at the beginning of the year. The Menard case, and yeah, that's the Menards, that's the hardware store, the race team, okay, that's the case. And he had a pay plan that was established, and it became a huge deduction, and the IRS lost the case. So we've got to do it right. We can still get to the right answer, but if you haven't done it properly, you're going to lose. And that's the downshot of that. Write-downs will be looked at, but again, if we do it right, there's all kinds of resources out there for us to determine what used equipment is worth. We do it right, company vehicles and Unicap. I want to talk, there are a lot of sales tax, state tax issues, sales tax, and income tax issues with doing business with customers from other states. Okay? If you're close to a border, if you got people on the internet coming over, so forth. Just bear in mind, we do presentations the third Thursday of every month at 11 o'clock Eastern. It's a webinar. It's open to anybody, just sign up for them. Last month's webinar was an hour long dealing with, specifically with, those problems. Bottom line is, The states are very hungry, they're very aggressive, and we've got situations where dealers are paying sales tax to 2 states because they haven't documented things right. So you're collecting it once from your customer for your home state or their home state, and then you're getting audited by the other state and you're paying the tax. And there are ways around this. So tune in, you can find it on our website, they're all recorded, and you can listen to that as well. The last thing that I want to talk about, and we are running over just a minute or two, is the Trump framework. First of all, it is simply a framework at this point. There's nothing hanging on that framework. So there's not a lot there that we can talk about in any detail. EDA is at a disadvantage right now. We're trying to formulate our position, and we don't have enough details to formulate a position on this thing. But here's the thing that you guys, there are 2 issues that you need to know about specifically with the framework. One of them is interest deduction, okay? Your floor plan interest. You guys all have floor plan, you guys are paying some interest. It's not a small number, right? Interest rates right now are low. They're likely to go up. They have been going up. They're likely to go up more. It will be a bigger number, okay? Under the framework proposal that Trump has put out there and other discussions that he's had, he is going to make your floor plan interest not deductible, okay? So he's going to be lowering your rates, C-Corp rates. The proposal is to lower the flow-through entity, S-Corp, and partnership and LLC rates as well. Take that away. That's probably not going to pass. We probably do have C-Corp rates that are going to come down. But in exchange for that, you don't get to deduct any of your interest, your line of credit interest, your floor plan interest, potentially your mortgage interest, okay? That's not a good situation. You guys need to talk to your, as this goes forward, you've got to talk to your legislators and say, that's a no-go for us. It'll cost you way too much money. It's going to cost you more. Most dealers cost them more in losing that tax deduction than it will in lowering the rates. Okay. And then the second one that I want to mention, and I'll get off of it, is LIFO. We talked about LIFO. There's been a discussion since Reagan was president about eliminating LIFO. Bottom line is, if you want more details, call me, but that can't happen. If that got passed, it would be the full Unemployment Act of 2018 is what that'd be renamed. Because every business that has inventory, so think about the grocery stores, think about Walmart itself, all the companies with inventory potentially are on LIFO, and there are too many businesses that have too big a LIFO obligation that they'd be bankrupt, just paying the tax bills. And so people will be without jobs. It's not going to happen, and that's why it hasn't passed for the last 30 plus years. Okay, I have run through my time. I'm going to advance to